November 2025. Americans' revolving credit, primarily credit card balances, fell by $2.1 billion, marking a 1.9% annual decline, according to the Federal Reserve. This represents the first sustained contraction in consumer credit card borrowing in over 2 years. Mainstream economic coverage treats this as positive news, suggesting consumers are exercising fiscal discipline and paying down debt. Here's what the consumers reducing debt narrative misses. People aren't paying down credit cards by choice, they're maxed out. Credit card balances reached $1.23 trillion in Q3 2025, an all-time high. Average APRs on cards accruing interest are 22.30%. When borrowing stops despite persistent inflation and stagnant real wages, it signals credit exhaustion, not financial discipline. The real story appears in the delinquency data. Credit card delinquencies reached 2.98% in Q3 2025, approaching the 3.25% level last seen in Q4 2011 during the aftermath of the Great Recession. Student loan delinquencies hit 9.4% with a 14.3% transition rate into serious delinquency, the fastest pace since data collection began in 2000. Subprime auto loan delinquencies reached 6.43%, exceeding levels seen during the past 3 recessions. This isn't about whether unemployment is low or GDP growth is positive. This is about recognizing when household balance sheets operate outside sustainable debt service parameters, and understanding what historically happens when consumers exhaust credit access while facing inflation-eroded purchasing power and rising debt service costs. By the end, you'll understand why consumer debt stress matters more than headline employment numbers, how the 4-stage household debt stress cascade reveals where financial pressure concentrates as credit exhausts, what $1.23 trillion in credit card debt, 14.3% student loan serious delinquency transition rate, and 6.43% subprime auto delinquency signal. Why 2008 to 2009 consumer credit crisis, early 1990s recession, and 1970s stagflation provide pattern templates, where today's delinquency indicators place households in the stress cascade progression. How consumer credit contraction creates business revenue collapse and employment pressure. The 7 signals showing stage 2 transitioning to stage 3 in household debt stress. Why this hits business owners and workers through reduced spending before headline recession announcements. Let me show you the pattern that repeats every time household debt service costs exceed sustainable levels relative to income. Stage 1. Savings depletion and credit utilization rise. Households maintain consumption despite inflation eroding purchasing power. Savings accumulated during periods of forced or increased saving get depleted first. Credit card balances begin rising as consumers bridge the gap between stagnant wages and rising costs. Utilization rates increase. Consumers carry larger balances month to month rather than paying in full. Delinquencies remain low because income still covers minimum payments. Home equity lines of credit see increased usage. This phase can persist for months or years depending on the severity of income-expense mismatch. The critical marker is the depletion of financial cushions while debt balances grow. This was 2021-2023 as pandemic savings evaporated and inflation persisted. Stage 2, credit card delinquencies. Spike and student loan payments restart. Credit limits approach maximums. Minimum payments consume larger shares of monthly income. The first wave of delinquencies appears. Credit cards default first because they're discretionary compared to rent, utilities, or car payments. Student loan payment moratoriums end, and borrowers who struggled during forbearance immediately fall behind. Credit card APRs averaging 22 to 24% create a debt spiral where minimum payments barely cover interest. Borrowers who maintained perfect payment histories during low-stress periods now show 30, 60-day delinquencies. Lenders begin tightening approval standards. New credit becomes harder to access, trapping struggling borrowers in high-rate existing balances. Geographic and demographic concentration becomes visible. Lower-income zip codes, younger borrowers, and regions with high essential costs show disproportionate stress. This is where the U.S. sits today. Credit card delinquencies rising toward post-crisis peaks, student loan transitions to serious delinquency at record pace, and borrowing contraction signaling maxed limits. Stage 3, auto loan defaults. Accelerate and essentials get sacrificed. Auto loans default at accelerating rates despite cars being essential for employment and daily life. This signals extreme distress. Consumers sacrifice transportation, knowing it threatens job access. Repossession volumes surge. Subprime borrowers see double-digit delinquency rates. But stress spreads to prime borrowers as even households with good credit histories struggle under combined pressure of inflation, high debt service, and potentially weakening employment. The K-shaped economy becomes more pronounced. Upper-income households maintain consumption. Lower and middle-income households cut discretionary spending aggressively. Retail, restaurants, and service businesses see revenue pressure. Bankruptcy filings begin rising. Credit card charge-offs increase, forcing lenders to reserve more capital against losses. The consumer credit market shifts from growth mode to loss mitigation mode. Stage 4, bankruptcy wave, credit contraction, and consumption collapse. Consumer bankruptcy filings accelerate. Lenders respond by dramatically tightening credit standards across all products. Credit card limits get reduced. New loan originations fall. The credit contraction becomes self-reinforcing. As lenders tighten, more borderline borrowers fall into delinquency, which causes further tightening. Business revenues fall as consumer spending drops. Companies reduce hiring or begin layoffs. Rising unemployment accelerates the debt stress as job losses trigger more defaults. The economy enters recession not from an external shock, but from internal household balance sheet exhaustion. The credit contraction precedes and causes the employment contraction. Where are U.S. households today? Deep stage 2. Transitioning to stage 3. Credit cards are maxed out. Student loans show record transition rates to serious delinquency. Subprime auto loans exceed recession-level stress. The system hasn't broken yet, but the progression is clear. The 2008-2009 financial crisis included a severe consumer credit component, often overshadowed by the mortgage collapse. Credit card charge-off rates, the percentage of balances lenders write off as uncollectible, peaked above 10% in 2009. Auto loan delinquencies exceeded 5%. Unemployment reached 10%, triggering a cascade where job losses caused debt defaults, which caused credit contraction, which caused more job losses. But the important pattern is the sequence. Consumer credit stress appeared before the unemployment spike. Delinquencies began rising in 2007, a full year before Lehman Brothers collapsed and unemployment surged. Households were already struggling with debt service when the systemic crisis hit. The consumer stress didn't result from recession. It contributed to causing recession. Lenders tightened credit standards aggressively. Credit card limits were reduced across the board. Banks stopped issuing new cards to subprime borrowers. Auto lenders raised down payment requirements and shortened loan terms. The credit contraction forced consumer spending to fall because households couldn't borrow to maintain consumption. Retail sales collapsed. Businesses laid off workers. The cycle reinforced. Today's situation shows a similar pattern with one critical difference. Unemployment remains near 4.5%. Consumer debt stress is appearing without a recession. Delinquencies are rising despite relatively strong employment. This suggests the stress comes from affordability erosion, inflation, and high interest rates, rather than job losses. If employment weakens, the stress will accelerate rapidly because households have already exhausted their financial cushions. The early 1990s recession followed a similar pattern. Consumer debt delinquencies spiked before unemployment rose. The economy entered recession in July 1990, but consumer credit stress had been building for months prior. The savings and loan crisis created stress in the banking system, but consumer defaults on credit cards and auto loans contributed significantly. The recession was relatively mild by historical standards. Unemployment peaked around 7.5%, but the consumer credit stress was severe relative to the economic contraction. This was because households had over-leveraged during the 1980s expansion and faced a painful deleveraging when the economy slowed. Credit card balances that seemed manageable with rising incomes became unsustainable when income growth stalled. The pattern is instructive. Debt taken on during expansions becomes problematic when economic conditions change even modestly. Households don't need catastrophic income loss to default. They need the buffer between income and minimum debt service payments to disappear. Inflation that raises essential spending plus interest rate increases that raise debt service costs can eliminate that buffer even with stable employment. During the 1970s stagflation period, consumers faced a different but related dynamic. Inflation persistently eroded purchasing power while wages failed to keep pace. Households borrowed to maintain living standards. Credit card usage expanded as consumers financed daily expenses they previously paid with cash. Real wages, income adjusted for inflation, fell significantly between 1973 and 198. By the late 1970s, consumer debt relative to income had risen substantially. The Federal Reserve under Paul Volcker raised interest rates aggressively to combat inflation, pushing the prime rate above 20%. Credit card rates, which float with the prime rate, exceeded 18 to 20% for many borrowers. The combination of high inflation, falling real wages, and high debt service costs created severe household stress. The result was the severe 1980-1982 double-dip recession. Unemployment reached 10.8%, the highest since the Great Depression. Consumer spending collapsed. The economy contracted sharply, but again, the consumer debt stress preceded the recession. Households were struggling with debt service before unemployment spiked. The high debt loads made the economy more vulnerable to the shock of aggressive rate hikes. The lesson: Inflation that erodes purchasing power plus rising debt service costs creates consumer stress even before recession. When recession arrives, the stress accelerates catastrophically because households have no remaining buffers. Credit card balances reached $1.23 trillion in Q3 2025, the highest level since the New York Fed began tracking in 1999. This occurred despite revolving credit contracting by $2.1 billion in November, the first sustained decline in over 2 years. The contradiction tells the story. Balances are at record highs, but new borrowing has stopped. Consumers have maxed out. Average APRs on credit cards, accruing interest reached 22.30% in Q4 2025. For consumers carrying balances month to month, this means nearly 1/4 of the outstanding balance accrues as interest annually. A household with $10,000 in credit card debt pays $2,230 in interest per year just to maintain the balance, before paying down any principal. The minimum payment on $10,000 at typical terms might be $200, $250 per month. Of that payment, $185 goes to interest, leaving $1,565 toward principal reduction. At this pace, it would take decades to eliminate the debt and cost tens of thousands in total interest. This debt trap is why credit card stress appears first in the household default cascade. Delinquency rates, the percentage of balances at least 30 days past due, reached 2.98% in Q3 2025. This represents a decline from recent peaks above 3%, but remains near the 3.25% level last seen in Q4 2011 following the Great Recession. The rate has been declining modestly for 5 consecutive quarters after 11 consecutive quarters of increases. But this modest improvement is misleading. Geographic analysis shows severe concentration. In the lowest income zip codes, serious credit card delinquency rates exceed 20%. Mississippi and Louisiana report overall debt delinquency rates above 40%. The stress isn't evenly distributed. It concentrates in regions where incomes have lagged inflation and safety nets are thin. The K-shaped recovery becomes visible in the credit data. Prime borrowers with credit scores above 720 show delinquency rates near historic lows. Subprime borrowers show delinquencies at or exceeding post-crisis peaks. The top 20% of households by income account for 2/3 of total consumption. The bottom 80% have seen inflation-adjusted spending stagnate. Credit card stress concentrates in the bottom 80%. Outstanding student loan debt stood at $165 trillion in Q3 2025. After years of pandemic-era forbearance, federal student loan payments resumed, and delinquent loans began appearing on credit reports again in February 2025. The result was an immediate spike in delinquencies. Seriously delinquent student loans, those 90-plus days past due, reached 9.4% of total outstanding balances in Q3 2025, down slightly from 10.2% in Q2, but up dramatically from 0.5% in Q4 2024 before payment resumption. More concerning is the transition rate. 14.3% of student loan balances transitioned into serious delinquency in Q3 2025, up from 12.9% in Q2, 8% in Q1, and 0.8% in Q4 2024. This 14.3% transition rate is the fastest pace since the New York Fed began collecting this data in 2000. It means borrowers aren't just falling behind. They're moving rapidly from current to seriously delinquent without making payments. This suggests not temporary cash flow disruptions, but fundamental inability to service the debt. The impact extends beyond the direct cost of loan payments. Student loan delinquencies affect credit scores, making it harder and more expensive to borrow for other needs. A borrower with student loan delinquency faces higher rates on auto loans, credit cards, and mortgages if they can access credit at all. This creates a cascading effect where student debt stress makes other debt more expensive and harder to manage. Student loan borrowers also face unique constraints. Unlike credit card debt, student loans generally can't be discharged in bankruptcy. Borrowers can't walk away. The debt persists regardless of income or ability to pay. This creates long-term financial stress that affects major life decisions, delaying home purchases, postponing marriage and children, reducing retirement savings. Auto loan balances totaled $1.66 trillion in Q3 2025. Overall delinquency rates, balances at least 30 days past due, reached 3.88%, the highest level in 15 years and approximately 1.5 times higher than mid-2021 levels. But the stress concentrates in the subprime segment. Subprime auto loan delinquencies, borrowers with credit scores below 620, reached 15.78% for 30-plus day delinquencies and 6.43% for 60-plus day delinquencies. The 60-plus day rate exceeds levels seen during the 2008-2009 Great Recession, the 2020 pandemic recession, and the 2001 dot-com recession. This is the highest subprime auto delinquency rate on record dating back to the early 1990s. Vehicle repossessions reached 1.73 million in 2024, the highest total since 2009. Repossessions represent the final stage of auto loan default. The lender takes the vehicle because the borrower cannot maintain payments. For most Americans, losing a vehicle creates severe economic stress. Cars are essential for commuting to work, accessing healthcare, buying groceries, and managing family needs. The average monthly payment on a new car loan reached $761. The average price of a new vehicle exceeded $50,000 in 2025, up approximately 35% since 2019. Average loan terms stretched to 69 months, with 84-month loans accounting for 22% of new originations. Longer terms reduce monthly payments, but increase total interest costs and create negative equity risk. Negative equity, owing more on the loan than the vehicle is worth, affects 28% of trade-ins, with an average shortfall of $69. Borrowers who financed vehicles during the 2021-2022 price spike now face underwater loans. They cannot sell the vehicle to eliminate the debt without paying cash to cover the gap. They're trapped in unaffordable loans. The auto loan stress matters because it appears last in the household default cascade. Consumers prioritize car payments because vehicles are essential. The old saying, you can sleep in your car, but you can't drive your house to work, captures the logic. When auto loan delinquencies spike despite this prioritization, it signals extreme household distress. Prime borrowers are beginning to show stress alongside subprime. Credit card late payments among prime segment borrowers increased 47% year over year. Superprime borrowers, those with the highest credit scores, saw serious delinquencies surge over 300% year over year, though absolute levels remain low. The stress is spreading beyond traditionally risky borrowers. This suggests the problem isn't poor credit underwriting or risky borrower selection. It's affordability erosion affecting households across the credit spectrum. Inflation raised essential costs, housing, food, utilities, insurance, while wages failed to keep pace. Interest rate increases raised debt service costs for variable rate products and made refinancing more expensive. The combination squeezed budgets even for borrowers with historically strong payment patterns. The Federal Reserve's Consumer Expenditure Survey shows the bottom 80% of households by income have experienced stagnant inflation-adjusted spending. The top 20% accounts for approximately two-thirds of total consumption. This K-shaped divergence means consumer stress concentrates in a segment representing 80% of households, but only one-third of spending. For businesses, this creates a bifurcated market. Luxury goods and services continue selling to the top 20%. Mass market retailers and restaurants see weakening demand from the bottom 80%. Employment in consumer-facing sectors becomes vulnerable as spending falls. Here are 7 signals to watch through 2026. Signal number 1, credit card charge-off rates exceeding 5%. Currently around 3 to 4% for major issuers, charge-offs represent balances written off as uncollectible. When charge-offs exceed 5%, it signals lenders are absorbing significant losses and will tighten credit aggressively. Signal number 2, student loan serious delinquency rate exceeding 12%. Currently at 9.4%, breaching 12% would indicate 1 in 8 student loan dollars is in severe distress and affecting millions of borrowers' broader credit access. Signal number 3, auto repossessions exceeding 2 million annually. At 1.73 million in 2024, crossing 2 million would match Great Recession peaks and signal mass transportation loss among lower and middle-income households. Signal number 4, revolving credit contracting for 3 consecutive quarters. 1 month of contraction occurred in November. If this becomes a sustained trend, it confirms credit exhaustion rather than temporary restraint. Signal number 5, prime auto loan delinquencies exceeding 1%. Currently near 0.5%. Doubling would indicate stress spreading beyond subprime and affecting the broad middle class. Signal number 6, consumer bankruptcy filings increasing 20% year over year. After remaining suppressed post-pandemic, a sharp rise in bankruptcies signals households exhausting all other options. Signal number 7, retail sales declining for 2 consecutive quarters adjusted for inflation. This directly measures consumption. If households can't borrow and real income falls, spending must contract. Next episode, the FDIC insurance fund crisis, how $129 billion covers $10.7 trillion in insured deposits. Bank failures are accelerating, and the 0.02% deposit insurance ratio creates the hidden backstop weakness everyone assumes works, until simultaneous withdrawals test it. The pattern is documented. The sequence is clear. The only question is whether you recognize household debt exhaustion before consumption collapse, business revenue decline, and employment contraction make recognition unavoidable through lost sales and layoffs. This isn't about predicting the future. This is about recognizing when consumer balance sheets operate outside sustainable debt service parameters, and understanding what historically happens when households max out credit during inflation and rising rates. The credit exhaustion phase delays consumption collapse temporarily, It doesn't prevent it.